Now in Excel. First off, the company had cash purchases of 150, so we're going to take a negative 150 and put it on the income statement. We're also going to do the same thing on the cash flow statement. So we have negative 150 on each. Next, the company has cash sales of 320, which we record as revenue on the income statement, and which we record as cash from sales on the direct cash flow statement. Next, the company has sales on credit of 310. This means we need to add to revenue, in addition to the 320 we originally recorded, we're now going to add 310 of credit sales for a total of 630. Since cash was not received for those sales yet, there's no impact on the cash flow statement. Moving down the list of items, we can now add some additional purchases that remain on credit. So the initial purchases of 150 will be further added to with the purchases on credit of 180. So we deduct another expense of 180. We now have a total of 330. Since the purchases were made on credit, meaning cash was not paid for them, there's no impact on the cash flow statement. Next up on our list of transactions, we see that receipts from receivables of 260 came in. What that means is cash from sales on the direct cash flow statement is going to increase by 260. We now have cash received from sales of 580. Next up, we see that payments to payables of 140 were made. That means we go to cash purchases and we add to that the payment to payables of 140. So now the total cash purchases outflow is 290. The next item, cash expenses, gets recorded on the income statement as an expense and gets recorded on the direct cash flow statement as a cash outflow. The last item that's left is depreciation, which gets recorded as an expense on the income statement. And now we are able to sum up the whole income statement and arrive at the bottom line, which is net income of 170. We can then calculate the total change in cash flow using the direct method, which was 220. Now we're ready to move on and calculate the cash flow statement using the indirect method. As always, we will start with net income, which we can link over to the income statement bottom line. Now we have to make adjustments for any changes in accounts receivable, accounts payable, and non-cash items like depreciation. First, let's calculate the change in accounts receivable. The accounts receivable balance at the start of the period was 0. And then, at the end of the period, was equal to the revenue minus the amount of cash for payments that were actually received. So there was an increase in accounts receivable of 50, but we actually have to reduce the cash flow by that amount since that cash was not received. Next, we calculate the change or increase in accounts payable. At the start of the period, it was 0, and then we subtract from that the difference between the purchases and the cash purchases. So this actually increases the cash flow by 40. And if we think about it, the company expensed 330 of purchases, but only actually paid cash out of 290. So this is a benefit to the business. Finally, we can link the depreciation, which gets added back since it was a non-cash expense. Once that's done, we can add up the entire indirect method, and we arrive at the same number as from the direct method. Congratulations, you've now built a reasonably complex cash flow statement from scratch.